And over the last couple of weeks, we had a little bit of a downdraft over concerns about the Delta variant. Now, maybe 2 weeks ago, remember, we had a down Friday and a down Monday, about 3% total down S&P. And then boom, within 3 days, completely forgotten and back to new all-time highs. Last week, of course, we had the China inspired little sell-off where some of the uncertainty around China spread into the U.S. tech names. And yet, lo and behold, again, we go back and we reach new highs. And so, to me, this is something that we have to respect. We're dealing with a very strong, in my view, equity bull market. I call it a pothole market. As you remember, we've talked about this many times. The market's going fine. It has a little downdraft, but it's like you're driving a car down the road, down the highway outside of Sao Paulo, and you hit a pothole. Yeah. You get a little bit concerned, but a mile down the road, you've completely forgotten about it. And B of A actually did some interesting work showing that the recovery time from big down days in the S&P is as short as it's been at any point in the last 100 years. So that just kind of supports analytically this idea of a pothole market. And so for me, there's the tactical issue and then the strategic issue. So tactically, the focus continues to be on the contest between the Delta variant spread in the vaccine production and vaccination surge. And the Delta variant spread gets all the attention, all the headlines. Even today, it served to kind of set the market back after a strong open. But interestingly, all it did today was just kind of cap the upside, as opposed to 2 weeks ago, it was taking us lower. And so I think the Delta variant is going to lose out to the vaccine production and vaccination surge. I would note that 70% of US adults and 70% of European adults have already gotten at least one shot. And the bulk of China.
The US reached the mark today, I just saw.
Yep, exactly. And Europe beat the US, which, 2 months ago, you would have never thought would be the case. Yeah. And so, and China is making news because it has a couple of hundred cases, but it's nothing like prior periods. And so to me, when you add together China, US, and Europe, you have the vast bulk of the global economy, and it's pretty well protected. The strategic issue continues to be the shift from a staggered reopening to a synchronized global expansion. And I believe that we're getting ready to manifest that. And when we do that, that's what's going to kick off the turn. So when I say approaching the turn in the title, the turn is away from growth stocks, away from the US equity focus, to cyclical and value segments of the US equity market in non-US markets, which have more cyclicality to them, particularly in the developed economies like Europe and Japan, as well as the commodity sector and markets that are exposed to commodities like parts of Latin America, Brazil, et cetera. And so that's what I mean when I say approaching the turn. I think we're very close. Just to give you a couple of data points, one we all know about, which is the extremely low level of US rates, nominal rates, but also real rates. Real rates in the United States are as low as they've been at any point in the last 50 years. And then secondly, the focus should be on understanding that US growth stocks are the stocks that rise, and I have this chart in my monthly, stocks that go up when US Treasury prices go up are at their most expensive versus the relative market at any point in the last 50 years. So I think we're very close to this turn, and I think the opportunity set is quite attractive with segments of the cyclical and value components having already had pretty big, healthy corrections. I just note XLE, the energy ETF in the US, is off 16% from its high of a couple months ago. So you have opportunities like that throughout the cyclical and value space. So in this ahistorical period, I believe technical analysis is very important for investors because, look, both men and machines can follow the technical levels. And day-to-day trading is increasingly done by machines and on algorithms. And so I think it really is important. And I personally am spending more time than I ever have looking at the technicals across the positions we have in our two model portfolios. And it really helps. And it helped on Monday a week ago because it was clear, just looking at some of the things like short-term RSIs and trading volumes and things of that nature, that the China ETFs were massively oversold. So that I said on Monday, and included that actually in the monthly that's up on the Ohm site. That Bloomberg clip is included there. But more importantly, where do we go from here? I think that the lows from a market perspective have probably been realized. I think there are probably going to be continued government discussions and clarifications and maybe more additional edicts on these subjects, because it's important to note that China doesn't run its economy on what U.S. and Western investors want to see happen, right? They are focused on building socialism with Chinese characteristics, and these issues, whether it's fintech and antitrust, whether it's data security with DD, or whether it's social equality with the ed tech companies, all these things are meant to make it easier to have families in China so they can deal with their demographics, make it easier to control their own technology, and shift the focus away from software to hardware. And China is very focused on trying to reduce its hardware deficit with, let's say, the West, right? Because they still get the bulk of their semiconductor chips from the West and from Taiwan. So there's a very big focus on shifting some of that intellectual capital away from stuff like social media to things like, okay, how do we develop AI? How do we develop our semiconductor capacity? How do we protect ourselves against things like the Huawei situation a couple of years ago with the US? We've made it very clear in the West that China cannot depend on the US, and to a lesser extent on Europe, for key components in its technological development. So they are focused on making them themselves. And so that's part of the issue with the focus on social media. The data stuff, we talked about it a year and a half ago in our Tripolar World 3.0 update, when we coined the term splinternet and talked about how technology was going to be a driver to the development of the tripolar world. And here we are a year and a half later, everybody wants their own semiconductor plant: Europe, US, China. The first point is that the bulk of the global economy is walled off from COVID, okay, with 70% of US and European adults having had at least one shot. In the bulk of China, COVID is not an issue at all. That's the important point. And I believe that the vaccination surge, which is now Delta is being the best force for getting people to vaccinate in the US at least, than anything else. The US is vaccinating more people now over the last week than it has in months. So that's also good news. Now on to the economy. Look, we've talked for a year practically now about COVID speed, first in, first out, follow the leader. China was first in, first out, came out, their peak growth was in Q1, year-over-year peak growth. Q2, there was still good quarter-over-quarter growth, and this is the distinction investors need to understand. Peak growth year-over-year does not mean that's the end of growth. China shows that. The US is going to show that, right? US peak growth was probably Q2. The data just came out. It was disappointing. Why? In large part because of inventory issues and supply issues. Demand was very strong. And so that suggests that Q3 is going to be quite strong for the US as well. Yeah, I think that's an excellent point because we hear so much about, end of cycle, late cycle, all this concern, all this risk, all these worries. Nobody talks about the potential for better than expected growth, right? For above trend growth. And look, the setup is there. The setup consists of three things. The first is the pro-cyclical spending of the Biden administration. This is where the infrastructure package is so important, and it looks like the hardest part of it The bipartisan part has been done, right? The big human capital part, the $3 trillion price tag, is going to be passed via reconciliation, not going to be requiring Republican votes. So the hardest part of the infrastructure dual track approach looks like it has been achieved on time. And again, this reflects the fact that Biden is a Senate guy. He was in the Senate for 30 plus years. He knows how to work the process. He knows how to work the system. Unlike President Trump, because there's been a lot of talk in the U.S. about why Biden's been successful with infrastructure and Trump wasn't, even though Trump talked a lot about doing an infrastructure deal, nothing ever happened, because he was not a political guy. He didn't know how, and nor did his team really know how to work the halls of power, let's say. Some people thought that was great. You know, if you wanted an infrastructure plan, you're way better with somebody like a Biden and their team getting it done. So that's first, pro-cyclical spending. And by the way, it's happening in Europe too, right? A lot of talk about Germany and the potential for the Greens to join the coalition with a focus on removing the debt brake there in Germany and letting fiscal spending continue to run. Some interesting stuff over the weekend with the European Minister of Finance saying the same thing. They need to update their fiscal guidelines to allow for pro-cyclical spending. So this is not just a U.S. issue. So pro-cyclical spending, CapEx boom, which you touched on, right? People need to understand that CapEx, both public and private, as a percentage of GDP in the United States, is at a 30 to 40-year low. We are in massive deficit for our spending on CapEx. And so I think climate is going to help drive that, right? So climate assures that we're going to have big government or government playing a bigger role in the next decade than it has in the last 30 or 40 years, at least in the United States. Again, important point to have people understand how this is all dovetailing together. Pro-cyclical spending, CapEx boom driven by climate. And then the third is this productivity surge. And Goldman has shown data that suggests that the productivity growth in the U.S. has doubled pre-COVID to post-COVID. And then there's a lot of work done by the guys at MIT and elsewhere who are the real productivity gurus, saying that this acceleration of COVID means that a lot of the technology that has been developed over the last decade is really solidifying and going to be driving things going forward. So there's a reasonable chance that instead of worrying about 1.5% growth, let's call it trend growth in the U.S. pre-COVID 2%. There's a lot that says one could think about above trend 3% growth in the next couple of years, driven by the things we just talked about, which is not really in anybody's wheelhouse at the moment, because it's so much easier to talk about why things are not going to work. I think that rates are the thing that doesn't really jive with where I think we are in the cycle, where we are in the economic reopening, where we are in the synchronized global expansion. Gold is not validating the real yield level, for example. Copper is not validating the interest rate level that we're at. So you can tote up a number of things that suggest that that we're not that far away, and maybe it's going to be the tapering that kind of sends a signal to bonds that they're mispriced. But I think at some point it might be the jobs number this Friday. If we get a really whopping jobs number, and people are saying could be 1 million jobs, if we get a big jobs number, if once infrastructure is passed, once tapering is done, I mean there are a number of potential catalysts out there. But earnings. Last point on earnings is that JP Morgan and others are now talking about $230 for 2022. That puts the S&P right now at 19 times earnings, forward earnings. That is expensive, but it's definitely not outrageous. And by the way, the segments that are going to really drive earnings in the next, we had this chart in the monthly, actually came from our friends at KKR. But the segments that are going to drive earnings over the next year are the cyclical segments. And again, not only in the U.S., but also in Europe. JP Morgan does a really nice job breaking out the cyclical earnings power in Europe versus the price action. And so while cyclicals are generating the earnings power, they're not getting the love in terms of their stock prices going up. So that, again, is creating the opportunity. There's a big part of the market that is ready to roll. And as I said, that's why I'm, more and more as I sat to write the monthly, it just struck me that there are a number of these data points that argue that we're approaching the turn. And, that's exactly why I titled the piece what I titled. So, we're overweight DM versus EM. That's been our clear view, for the last year. We think the real play is in Europe and Japan more than in broad EM. We think that China now clearly has gotten much more reasonable value-wise. And so I think holding China equity at this point is probably a pretty decent risk-reward. But we like Latin America in particular. Because it is tied to the commodity cycle. And again, just like we've talked about a number of things, not kind of confirming traditional relationships, Latin American equity and the commodity cycle is another one that has not, been its traditional relationship. And we think part of that is, again, COVID. Part of that's the political response to COVID. But we do think that those relationships are going to reassert themselves. In the case of Brazil, we've been bullish on the currency. We've been bullish on the equity market. The currency did break below 5 and then, of course, has pulled back. We think it's going to go back under 5. We think rates are likely to go higher, but that's not going to be a problem for the equity market. And we continue to think Brazilian equities and Latin American equities in general, Mexican equities, Chilean, et cetera, are pretty interesting here. So, we're overweight we're overweight non-US, we're overweight DM versus EM, we're overweight Latin America versus Asia within EM equity. We continue to hold EMLC, and that would be the bulk of our equity exposure. In China, just to be clear, we own a healthcare related ETF, KURE, which we see as a growth area within China. And we think it's unlikely to get significant negative government action given the importance of healthcare to an aging demographic.